Hi everyone and welcome. I'm Carol Dewey with Perpetual Wealth Financial, and today we're digging into one of the most common and costly mistakes I see, waiting. Whether it's delaying a tax strategy, putting off updating your estate plan, or hesitating to diversify an overexposed portfolio, the truth is procrastination can be more expensive than a market correction. In this discussion, we'll unpack why time is either your greatest ally or your most dangerous adversary when it comes to building and protecting wealth. I'll share real-life examples from client conversations, and you'll leave with practical steps you can take right now to avoid letting delay derail your legacy. So let's dive in. We're going to talk about something that's often underestimated but universally impactful, the real cost of waiting. When it comes to your financial plan, and let me be very clear up front, this is not about fear. This is about math, mindset, and missed opportunity. In the world of finance, timing isn't everything, but it's close. Whether you're a business owner, a high-income earner, or someone approaching retirement, procrastination can be the most expensive line item in your wealth equation. Let's talk about the illusion of later. Sometimes the biggest delays come from the heart, not the head. A client named Jack was a former C-level executive at Kmart. Over his 35-year career, he'd accumulated more than $3 million in Kmart stock through bonuses and personal investment. Every year I urged him to diversify. Every year he politely declined. Kmart's been good to me, he'd say. But as we all know, Kmart didn't survive. His loyalty and delay cost him the comfortable retirement he deserved. We all have reasons to wait. Life is busy, work is demanding, kids need our attention, business fires need to be put out. So we say, I'll do it later. But later rarely arrives on schedule. Think about this. If you delay making a key financial decision, whether it's reallocating a portfolio, starting a Roth conversion strategy, restructuring your estate plan, or evaluating your business exit strategy, you're not just pushing a task down the road, you're compounding the impact of inaction. Why? Because money has momentum. Your dollars are always moving, either compounding for you or eroding due to taxes, inflation, fees, or risk. Waiting isn't neutral, it's negative. It creates drag on your entire financial engine. Let's look at a few examples. Missed compounding and opportunity costs. Einstein called compounding the eighth wonder of the world. The earlier you start, the more powerful it becomes. Waiting even a few years can have devastating effects on long-term wealth. Take a business owner who plans to sell their company in 5 years. If they delay value acceleration strategies or tax-efficient planning until year 4, they've just eliminated 4 years of potential compounded returns on a better valuation, a lower tax bill, or an optimized exit structure. Or consider the retiree who hesitates to begin Roth conversions now, waiting to see what happens with the tax law. They risk missing the narrow window between retirement and RMD age when taxes are artificially low. Once RMDs hit, those conversions become dramatically more expensive, if not entirely out of reach. Waiting has a cost. It's called opportunity cost. And in financial planning, it's the silent killer. Then you have tax friction, the ticking time bomb. We talk a lot about taxes in our planning process, and for good reason. The IRS is your silent business partner in most of your wealth building tools, especially in tax-deferred accounts like 401ks and IRAs. When you wait to address the tax friction in your plan, you're essentially letting that silent partner grow their share. Let's say you've accumulated $2 million in tax-deferred account. At a 25% effective tax rate, that's a $500,000 reservation for the government. But what happens if tax rates increase or your RMDs push you into a higher tax bracket? Suddenly that 25% becomes 30% or more. If you had started pre-planning with strategic Roth conversions or charitable planning years earlier, you might have trimmed hundreds of thousands off your tax bill. Waiting just increased your lifetime tax liability and your heirs too. One couple I worked with, Matt and Deborah, were DIY investors who had built a conservative portfolio with bonds. But when interest rates dropped and their bonds were called early, they weren't ready for a tax strategy. They came to me wanting to defer taxes, but had already missed out on years of planning opportunities. Their delay meant they paid more in taxes and missed out on stable tax-deferred growth. Then we have risk and reward timing. Let's talk about risk. Not the market roller coaster kind, but the planning kind. Risk isn't always about being too aggressive. Sometimes it's about not being compensated appropriately for the risk you are taking. Delaying an annual portfolio review can mean you're carrying too much exposure to outdated sectors or missing out on tactical shifts that better align with your goals. Over time, that mismatch can result in lower returns or increased volatility, both of which erode confidence and wealth. Delaying a risk assessment on your legal documents, like updating your trust or power of attorney, could mean your family is stuck in court or conflict if something happens unexpectedly. I recently worked with a retired couple whose portfolio looked solid on paper, but once we ran our lifestyle and legacy assessment, we saw that their investment mix was far more aggressive than they were comfortable with. Structured notes and annuities were hiding some of the risks, but not enough to protect them in a serious downturn. They were shocked. Had they continued waiting, a market shift could have devastated their retirement income. Again, delay has a cost. Often it's measured in emotional dollars as much as financial ones. Then there's business planning and exit readiness. For our business owners, this discussion is especially critical. Most owners wait far too long to plan their exit. They focus on growth and operations, assuming they'll figure it out when they're ready to sell or retire. Here's the problem. As exits don't happen on your schedule. Sometimes health fails, a partner wants out, a buyer shows up unannounced, or a family member who was supposed to take over changes their mind. Without planning, you're not just vulnerable to poor outcomes, you're leaving value on the table. Value acceleration takes time. So does tax planning. So does estate equalization if you have kids inside and outside of the business. Waiting to plan all of this until you're ready can cost you the kind of exit that creates generational wealth. And the hidden costs, stress, conflict, and lost confidence? Financial delay isn't just about dollars. It's about mental drag. That gnawing feeling that something's off in your financial plan. That worry that your spouse couldn't step in confidently if something happened to you. That frustration when you know you should be doing more but can't find the time. These are hidden costs of inaction. They manifest in stress, sleepless nights, and marital tension. They rob you of the joy today, even if the financial impact isn't felt for years. And ironically, the more successful you become, the more costly inaction becomes, because the stakes are higher, the complexity is greater, and the margin for error is smaller. So how do you move from procrastination to purpose? What do we do? The first step is to reframe the conversation. It's not about getting around to it. It's about being a good steward of what you've built. If you've created wealth, a business, or a legacy, it deserves intentional planning. It deserves action. That doesn't mean doing everything at once, but it does mean committing to progress. Start by identifying one area of friction in your plan. Is your portfolio overdue for a second opinion? Do you have a tax liability that needs attention before the next deadline? Are your estate documents outdated or non-existent? Have you mapped a true succession or sales strategy for your business? Then take the next step. Don't wait until it's perfect. Perfect is the enemy of done. Every day is a decision. In closing, I want to leave you with this. Every day you are either compounding your progress or compounding your problems. There is no pause button in wealth. Delaying decision doesn't freeze the clock. It accelerates the consequences. If you're waiting for the right time, it's now. If you're waiting until you're less busy, you won't be. And if you're waiting until you have all the answers, you'll always be waiting. Let us help you get started. Whether it's a lifestyle and legacy assessment or a conversation about your business exit, take the next right step. Because the cost of waiting is the one expense that never shows up on your balance sheet, but always gets paid. Thanks again for joining me today. If you found yourself nodding along or thinking, hey, I've been meaning to handle that, then now's the time. Our lifestyle and legacy assessment is designed to help you uncover inefficiencies, reduce risk, and align your wealth with your purpose before time steals the opportunity. You can schedule a complimentary assessment by visiting www.perpetualwealthfinancial.com or call 877-434-6243. Until next time, I'm Carol Dewey, helping you navigate the financial seas so you can get on with living. We'll see you next week.